I am seeing more disagreements on a couple of key elements. One is the direction of inflation, and kind of tied to that is the direction of bond yields and bond prices, because in many ways they're a function of inflation expectations. So we're at one of those moments in markets where really smart people can look at the same data and come to quite different conclusions. If you're an investor and you're having a hard time trying to really pin down some of these key issues, I think there's a growing consensus that we somehow got out of amongst investors in general. All of the massive deformations of the unprecedented stimulus of the COVID era without really having to pay a price for that. Narrative has shifted to soft landing / no landing. Federal Reserve hike interest rates more aggressively than it has in our living lifetime, and yet no recession materialized from that higher cost of capital. So I think there's a strong sense of the status quo is very resilient and it's just going to keep on going. And I would say be very careful about that, because I think actually when you look at what's happening right now in the macro stage, the game is changing. It's changing in many different ways.
Adam Taggart warns investors to be cautious about assuming that current market trends will continue. He highlights disagreements on inflation, bond yields, and the long-term stability of high valuations. While markets have seemed resilient, he believes the landscape is shifting due to factors like central bank actions and rising volatility. He advises investors to prepare for potential downturns by diversifying and hedging against economic risks. Taggart also suggests owning precious metals as a safeguard, particularly as the US dollar faces challenges from competing currencies, though he believes the dollar will retain its dominance in the near term.
Obviously, very clearly, we're going to have a new US president in a week, but we are in a new regime for interest rates. After several years of aggressive interest rate hikes by the Fed and a lot of its other brethren central banks, pretty much all the world's major central banks now are back to cutting interest rates. Interestingly, the bond market is starting to push back on the central banks. So we've seen the Fed cut interest rates here, and what's happened since? Bond yields have gone up on the long end of the curve. Mortgage rates are back up. So that is different. That hasn't happened in a long time. Valuations are at really rich extremes right now, at the same time when consumers are increasingly tapping out. So this just raises the question of how high do trees grow, right? They don't grow to the moon. Valuation multiples can't just keep increasing forever unless there's some fundamental reason for that. But PE multiples are growing much, much faster than actual earnings are at this point in time. And then lastly, we're seeing volatility return, both in the stock market, as measured by the VIX, but also in the bond market as measured by the MOVE index. So there's lots of changes that are happening here for folks that are paying attention. And kind of each one of those that I mentioned has the potential to have real implications, both for either economic growth or where asset prices are headed in the future. I think a lot of investors here are just saying, look, we had a great 2023. We had a great 2024. Everything looks great right now heading into 2025. I'm just planning for this status quo to continue. I kind of liken it to the person whose team won the World Series or the Super Bowl the previous 2 years. And you get in this mindset where you just assume it's going to be a three-peat, right? Not realizing how statistically improbable that is. I'm not saying the wheels are going to come off from the markets or the economy per se in 2025. They could, and we could talk about that. But I do think just like if you're used to your team, getting that title ring every year, and year 3 comes along and they make the playoffs, but they don't go win the championship, you're disappointed. You set yourself up for disappointment. I think investors in a similar way are setting themselves up for disappointment next year, even if we still have an up year in the market. I think what matters more in the near term is if the easy tailwind that we've returned to enjoying since the end of 2022, if that starts becoming more turbulent, I think it's going to, catch a lot of people increasingly out of position. I'm right there with you, and we could talk the whole time about any one of those big trends, loss of reserve currency, sovereign debt crisis, the social upheaval that comes with a Neil Howe style fourth turning. The thing I would caution people is those things take a long time to play out. Whatever your primary thesis is, make sure that you've got some hedges in place in your portfolio in case your primary thesis doesn't play out over the timeline that you're hoping or needing it to. Because I've seen lots of people take drastic action in their portfolio because of some of these big cyclical fears of, sea change fears. And then oftentimes it takes a lot longer to play out than most people think. And even when it starts, it's not something that happens overnight. It happens over many years, maybe decades. I've seen people take extreme positions and they might be proven right in the next 5 5, 10, 20 years, but they can get wiped out multiple times along the way just by the regular up and downs of the system still continuing to work more or less like it has. I do think that increasingly we as a system will start to hit into those big major issues. The system itself is unprepared for them. And generally the way things tend to work there is the system resists, right? You remember every player in power in the system is trying to keep the status quo going. And that's one of the reasons why it can last so much longer than we think. You really, I think, want to wait until you see real big visible cracks in the system, the banking system starting to really freeze up, things like credit spreads blowing out in ways that we haven't seen for years, real signs of systemic stress like that before you make any really big bets on some of those major calamities. You start by building your own, whatever you want to call it, Armageddon insurance, right? And this is physical metal that you can get your hands on very quickly, right? Don't necessarily need to keep it in your house, but somewhere local where you can get your hot little hands on it, in an emergency, should you need to. Only you can determine what the right size of that is. And the rule of thumb is, have as much as you can still sleep well at night, with, but you don't want to have too much because then it becomes either a theft risk or a loss risk, right? Above and beyond that, if you still want to have exposure to physical that you can get if you need to, but not necessarily within minutes, that's where the storage options come into play. So that's what I kind of call like your core investment in precious metals. Now, if you think that, and again, I'd say for most people driving that, it is emergency wealth preservation, and that is sort of like protection against a currency collapse. I don't think that's likely to happen. I think that the purchasing power of the dollar and all world fiat currencies is going to continue to erode from here, and probably at a faster rate than it has in the past. But I don't think you and I are going to wake up tomorrow and basically see the dollar, in complete crisis. I think it's going to be a process, not an event. But in case I'm wrong, right, I'll wake up tomorrow with more ounces of precious metals than 99.999% of people out there, right? And you don't need to have a lot of ounces to make that happen, right? As you know, the average US household probably has no ounces. So anyways, you have that at the start, then you graduate. If you want to still have more metal, but not keep it at your home, look at one of the vaulting solutions. Just make sure you're doing it on an allocated basis and not a pooled basis. Now, if you then think, hey, I think that the precious metals prices are likely to go up from here for a whole variety of different ways, and you have additional capital that you want to put into practice on that, that's where the paper gold ETFs and the mining stocks come in. If you just want to speculate on price, own the ETFs. If you want to really try to get leveraged exposure to the price, obviously then own the miners. What I do is I own all of those, right? But that's the order in which I built my exposure. Right now, if you're buying in the mining stocks have not caught up with the metals by any stretch, but they are showing life now, right? The GDX index is certainly higher than where it was when it started the year at this point, right? So we're seeing the beginning of momentum from here, right? So what I have done is I've captured some of the beta, right? So I own some of the major ETFs in the mining space, but I don't have a ton in them. And the reason for that is I like the Rick Rule strategy, which is highly volatile space. When you own the ETFs, you own everything. And there's kind of a lot of dogs in there, right? It's mining. There's a lot of uncertainty, right? He says it's not that hard to pick out the diamonds. If you want to own GDX, which is the majors, right? Well, again, you're owning all the majors, but there are definitely some world-class companies there, the Wheaton Precious, Franco-Nevadas, the Agnico Eagles, et cetera, where, if you just own the diamonds, you're likely to have a much better longer-term return because they're not getting dragged down by all the dogs there. You're still capturing a lot of the beta of the diamonds without getting the negative beta of the dogs. And then when it comes into the getting down lower in the stack in terms of more junior companies, again, this is another instance in where I say, look, unless you've spent a decade or more following this industry and you've gotten on a plane and visited mines and you've got personal relationships with the executives that manage these companies, you're highly better off following somebody who does. And there are great people out there. So a lot of them have great newsletters that you can follow. You can literally look over their shoulders, follow their trades. They'll tell you what they're buying, why they're buying it, and then you can decide if you like it or not and add it to your portfolio. So I definitely follow several people when I get down to more of the junior mining companies where I'm not making the pick myself. I'm looking at these guys and saying, who do you think is the best of what's out there, and going with their expertise. I think Rick Rule says, look, I don't like to focus on what's loved. Don't tell me about what you love. Tell me about what you hate. He basically has made the vast majority of his money investing in sectors when they were left for dead, right? When nobody wanted to touch them. There's a lot of untapped opportunity here. Now, you and I can talk about, the evolving geopolitical situation. We can talk about loss of purchasing power in fiat currencies. There are all these big macro tailwinds that should be very positive for commodity prices going forward. Yet, I'm sure you've seen the charts of, commodity prices to the S&P, we're still kind of at a historic low in that ratio, which again, I think investors like Rick Rule love to see, right? Because extremes are called extremes for a reason, right? They eventually revert, right? And you can make a lot of money on that mean reversion. And I think one of the things that's particularly interesting about the precious metals complex right now is, do you remember when Grant Williams wrote that piece 8-9 years ago titled Gold, Nobody Cares? And he was basically talking to guys like you and me who were in the gold trade for all the reasons that we're in it right now, right? And he said, look, you're probably right. The problem we have right now is that nobody cares. And what's interesting is since he wrote that piece, gold had a lot of rough years in between 2012 and, just a few years ago. Investors just didn't care. Now, in recent years, central banks have really started caring. They've really started swapping out sovereign debt, namely U.S. treasuries, on their balance sheets for gold, right? So they're net big buyers of gold. The Asian speculator has woken up and said, look, we can't get enough gold. And they've been buying hand over fist since, right? The Western investor, the Western speculator, has not cared. Now we're beginning to see some initial signs, some initial positive flows into the ETFs, a few things that it's maybe beginning to catch the eye of the Western investor. And if it does, that is a massive opportunity for price here for the reasons which you mentioned. Wall Street, I think, has a bias against gold, but Wall Street has a much bigger bias for momentum and making money. And once it really starts thinking, hey, there's really money to be made in this sector, capital is going to move there. And as you know, this space, particularly, gold relative to general stocks or bonds, very small. Silver, tiny. The mining complex, infinitesimal, right? So you get this potential asymmetric upside of not a lot of percentage of capital flowing out of stocks or bonds into this space can have a dramatic positive upward explosive effect in price. When I look at this space, I think that's kind of your competitive advantage. If you're right, I can see a lot of reasons why the Western investor is increasingly going to be forced to have to care about gold. And as gold is now hitting record highs, I think Wall Street's really beginning to wake up to this and say, hey, something interesting is going on. Luke Groman, and Luke is so bearish on bonds, on mid to long-term sovereign bonds. He says they're uninvestable for the foreseeable future. Let's just assume for a second his thesis is correct, that they're going to have a much tougher time going forward. If 1% or 2% of capital were to leave the bond market and move into the precious metals complex, what impact do you think that would have? It would be gargantuan, right? Look, do I think the dollar will increasingly over time experience increasing competition from other currencies, both existing and new, like a BRICS currency? Yeah, I do. Will we lose our world reserve currency status? Yeah, probably at some point in the future. I tend to agree with Brent Johnson. He can pull up headlines from the 70s on about challenges to dollar hegemony. And he's like, look, we hear this all the time. You got to just balance it with the rubber on the road. And in many cases, for a lot of these things, it's just talk. And a lot of what's been going on with BRICS, the concept of competing currency, maybe one that's, priced in gold. There's been an awful lot of headlines about it, but very few actual definitive decisions made on it. I think one of the challenges you have too with the BRICS, as you sort of alluded to there, is, a lot of these countries that are in BRICS historically have not had great relations. It's not like the Western Alliance where we have these, multi-decadal or sometimes centuries-long alliances. This is the wrong term to use, but there's sort of like how much honor is there among thieves? Like when times get tough amongst this coalition, how tight are they really going to be versus starting to fracture for each nation's own self-interests, right? I think the odds of that are low. I think it's going to be really hard for the dollar to get displaced as the world reserve currency for two big reasons. One is just structurally, the demands that would place on the currency that would need to replace the dollar are tremendous in terms of depth of market and adoption worldwide and world payment structures and things like that. So just the logistics is really hard. But secondly, the US understands it has a magnificent advantage with that, being the world's reserve currency, and it is not going to go quietly in letting the sun set on that. And there are a lot of dirty tricks that the US could play that it hasn't even begun to yet to protect that advantage. I don't think it's something to be betting heavily on any near-term time frame, but let's say I'm wrong. Let's say, next month they unveil the new BRICS gold-denominated currency and countries around the world rush to start using it. I hold more gold than 99.99% of Americans. I'm going to benefit from that.
In conclusion, Adam Taggart reminds us that while markets may seem stable, underlying shifts could bring unexpected challenges. He encourages thoughtful preparation and diversification, emphasizing that relying on past trends can be risky in an evolving economic landscape. By staying vigilant and hedging against potential disruptions, investors can better protect their wealth in uncertain times. Remember, a well-prepared strategy is the key to navigating future market changes with confidence. Thank you for watching and stay tuned for more insights.